Hi everyone, Bowen from Enhanced Asset Management. Just back to provide an update today as we head into reporting season. We've had a few companies report so far. We'll just provide a little bit of a broad market update as well to help you understand sort of, where the market's going at the moment and some of the factors that's driving the volatility. So we'll start off in the Middle East, and look, we've seen ceasefires be in place, ceasefires be gone back on, and we've been to and froing for probably a couple of months now, and you can see the volatility in the oil price there. It's sort of looked like it was bottoming out in July, and then it kicked right back up as that MOU sort of fell through, and now we've dipped back down as it looks like the US might be trying to get out of Iran. But ultimately, we have no idea where this is going to go, whether the conflict kicks up again and you see that oil price spike back up, or whether the US cut their losses and exit Iran and you see that oil price come down. It's on a nice edge, and we can't really be out there predicting what Donald Trump and what the US are going to do. So expect a little bit more volatility as this thing keeps playing out. And what that's doing to our market in particular, given we're pretty heavy importers of oil, is it's got our bond yields bouncing around a bit, and you can kind of track that with the oil price there that sort of mid June, towards the end of June, start of July. You saw that the bond yield really looked like it was starting to roll over, which was going to be very positive for equities. But in the past sort of month or two, we've seen the MOU fall through, oil prices tick back up, and our bond yields tick back up as well. So that's just providing a little bit of further volatility as we head into reporting season. So far, we've had 3 companies report, those being REA Group, ResMed, and Car Group. So we'll run through those results with you today. So we'll start with REA, who reported last Thursday, I believe, or last week. And the expectations from the market going into this result were pretty low. We had interest rate hikes. I think we've had 3 in the past couple of months, and the changes in the federal budget that were really targeting property created a real negative sentiment towards the stock going into the result. And we saw some analyst reports prior to the result coming out forecasting 8 to 10% reductions in listing volumes for FY27. We were a little bit more bullish on the stock, and we forecasted just a 2% reduction in listing volumes. Ultimately, management have guided for flat to low single-digit declines in FY27. And, I guess our thesis there was there's a lot of changes in that federal budget that are going to result in people probably selling property. So you'll have a lot of turnover. With the CGT changes, the changes to family trust tax, we just thought that the market was probably trying to correlate the stock a little bit more in the sense that a negative house price environment meant negative listing volumes. We just didn't see that correlation being perfect. So while we do expect a bit of a weaker housing price environment, we still expect turnover to be relatively flat. And I think that's where the market probably got this one wrong. Buy yields are expected to increase in the low double digits, meaning that revenue will grow probably around 10% for FY27, which was in line with our forecasts and ahead of where the market thought it was going to be. They're expecting some further operating leverage, and that will result in earnings growing around 15% in FY27. So with the multiple that this one derated to continue to grow at 15% is a fantastic result. And as you can see here, the market has rewarded that result, and it's really bounced pretty well off those lows we saw back towards the end of June. You can kind of see where a lot of the derating came from post the federal budget in May here, and that stock plummeted all the way down to about $130, which was insanely cheap, and we've now seen that come back virtually to where it was as the federal budget was released. And we still think anything under $200 for this stock is really good buying. So we're happy holders here. We increased our weight after the result, and we expect to see some good performance from this one throughout FY27. So next up, we had ResMed report on Friday, and this is a stock that has typically traded pretty negatively on results, and this one wasn't really too much of an exception. The market doesn't need too much to trade this one down on results day. It was a bit of a messy result. They've obviously divested their Matrix Care business, purchased another business, Notrix, and have also had a product recall for some of their Astral devices, which only make up a minor share of ResMed's business, but have an impact on the result. Revenue was up 8%, earnings per share was up 16%. These were ahead of our expectations. There were, however, some slight margin pressures guided for FY27, particularly in the first quarter, as freight costs and electric components costs rise, particularly as a result of the conflict in the Middle East. These costs will be offsetted throughout the year from some pretty minor pricing increases and some business efficiencies as well. So they're guiding for 5 to 7% revenue growth in FY27. Again, noting a 1.3% headwind from that product recall. So normalised, we're looking around 6 to 8%, which was in line with our forecast. They are also guiding for the core business earnings per share to grow between 12 and 14% for FY27, which, similar with REA, you're getting a absolutely fantastic quality business that continues to pump out earnings per share growth in the low double digits, and the multiple that this thing's trading on is extremely attractive. They also announced a 5-year outlook. They're guiding for high single-digit revenue growth with earnings per share higher than that. So you're looking at low double digits, which is the core thesis for this business. It keeps trucking along perfectly, and despite the share price re-rating negatively over the last sort of 12 months, we're really confident in the business fundamentals, and we expect this one will re-rate. It might be 12, 24 months, however long it takes. This is a business that just keeps on keeping on. And so we saw the share price fall around, I think it was 8% on Friday. It's bounced back about 4% today, so it's down around 4% since the result, which kind of goes in line with what we've seen when they report over the last probably 2 or 3 years. The market sells it off, and then it bounces back pretty steadily. So again, $30 per share. We've got a valuation up towards 40. We expect this one will continue to trade pretty well, despite some probably, it might be a soft quarter for the first quarter of FY27, but after that, we expect it to be pretty smooth sailing for FY27. Finally, we had Car Group report today, and they reported a really strong result. They had 10% revenue growth, 9% EBITDA growth, and it was strong growth across all of their regions. So in Australia, North America, Latin America, Asia, they all grew really strongly. Particularly Latin and North America, they were the key growth drivers. Their revenue growth was 19% and 12% respectively. They also guided for FY27 revenue growth of 11 to 14%. This was above our forecast, which was around 10%. They also guided for 10 to 13% EBITDA growth, again, around about 1 or 2% above where we sort of expect it to come in. They made it pretty clear that AI is continuing to be a tailwind for this business, improving their customer conversion, and they're driving operational efficiencies rather than disrupting the business. Again, something that we've long forecasted, but the market hasn't really agreed with us for a while. But it's really nice to see that these companies are continuing to report really strong numbers, and AI is their friend. Again, the market's rewarded this one pretty well. I think it's up 9% today or something around that, and it's breaking out to some new highs. So this one had been pretty well range bound for the past sort of 6 months, and we've now seen that kick up over $29. And again, we have a valuation north of 30, so we expect this one will continue to trade pretty well. So in summary, the portfolio companies that we've had have reported really, really well to start reporting season. There's some elevated market volatility and ongoing geopolitical uncertainty, which we expect to remain. Quantitative, a lot of the quants and the AI pricing and the algos has really created a pretty volatile environment for reporting seasons over the past few seasons, and we don't expect this one to be any different. So expect a lot of volatility on the result day for portfolio holdings and the stocks you hold yourself. But ultimately, share prices will follow earnings, and we're really committed to finding some mispriced opportunities out there, and we're really confident that the portfolio, the holdings that we've got within the portfolio, will continue to grow their earnings. And look, at the moment, we're seeing they're growing their earnings quicker than what the market is forecasting, and we expect that to be a bit of a tailwind for the portfolio moving forwards. As always, this is general information only. If you do require any further financial advice or have any questions, please reach out to your licensed advisor. Thanks, everyone.